Chinese investors dump $42.6 billion in U.S. securities amid geopolitical strains by Satori News. In a historic move, signaling deepening economic rifts and rising diplomatic tensions between the United States and China, Chinese investors have unloaded a record-breaking $42.6 billion in U.S. securities this past May. This massive sell-off is part of a larger trend wherein Chinese holdings of American assets have decreased significantly, highlighting a strategic shift by Beijing in diversifying its investments amid international uncertainties. The U.S. Department of the Treasury's latest dataset revealed that the divestment primarily encompassed long-term U.S. securities, including Treasury notes, corporate bonds, agency debt, and equities. The most significant proportion of the sales was Treasuries, which are often considered a barometer for bilateral economic relations and investor sentiment. Factors driving this substantial move by Chinese investors are multifaceted. Billy Lung, an investment strategist at Global X Management Co., posits that the looming uncertainty of the U.S. presidential election and the consequent desire to hedge risks are likely catalysts. Additionally, there may be political motivations behind the shift, specifically a strategy to reduce reliance on dollar assets. The broader implications of this divestment are of particular interest to bond market investors and geopolitical strategists. China's withdrawals from U.S. Treasuries have the potential to exert upward pressure on yields due to reduced demand. Moreover, the divestment coincides with expert analyses suggesting that U.S. dollars and equities are currently overvalued, especially when juxtaposed with their Chinese counterparts. As noted by macro strategist Weiliang Chang of DBS Bank Limited, the trend of Chinese investment away from American assets could persist. The driving forces include not just economic foundations, but also the political unpredictability leading into the U.S. elections. On the backdrop of these developments, there is an increasing suspicion that China is reorganizing its U.S. dollar holdings rather than outright decreasing them. Belgian accounts, perceived as a repository for China's custodial accounts, have seen an uptick in the balance of U.S. securities, which runs counter to the downsize observable in China's direct holdings. Lastly, Ken Wong from Eastspring Investments Hong Kong Limited suggests that anticipated policy easing by the Federal Reserve could weaken the U.S. dollar, deterring Chinese investors from heavy dollar-weighted portfolios. This prediction complements a potential pivot to investments in regional markets that could become more attractive propositions as the dollar loses ground. While the future of Sino-American economic relations remains turbulent, the recent events point to a recalibration of investment strategies that will reshape the global financial landscape. Thank you for choosing Satori News.